investors come to us all the time that are professional investors. They have their own portfolio, but they are tired of being an active landlord and they want to sell those assets, and they often tempt everyone exchange into deals with us into now a more passive role while still getting the benefits of real estate ownership. But anyway, that's a bit of a digression, because the point is that's very time consuming, very difficult, poorly compensated. Whereas capital raising, I don't want to say it's easy. Capital raising is not easy, but
And it's never been harder either, might I add.
true. But at least you get to sit back comfortably and you get to go on lunches and dinners and you can do podcasts and you can talk to investors and stuff like that. So it's a bit different. But anyway, so the space has grown tremendously with a lot of people being interested in raising capital, which then they pool together in these fund of funds and syndications and then invest in deals like ours. So what we've now noticed is, because a lot of bad deals got done in 2021 and early 2022. And now you use that term snake bit, which I don't think a lot of people really understand that term or what that means. But basically people are having a bad experience with deals that they raised money for and invested in 2021, which is now causing them to act differently. So what do? One thing that we've now seen has grown tremendously in popularity is capital raising partners group together to kind of share deal flow with each other, share due diligence, and really what they're doing is they're trying to not look stupid. Investors, and this is something that you see from top to bottom, from the entire spectrum of the investment universe, you find that a huge concern, and perhaps the number one concern, is to not look stupid. And the funny thing about not looking stupid is the way that you look stupid is by going against the group, going contrarian, right? But we all know that being contrarian is the way that you actually make the most money in investing. So it's a very funny paradox, and this is what makes investing so fascinating and so difficult, is because it is against human psychology to invest well. And with these new groups that are forming, these masterminds or these cliques or whatever you want to call them, of people that want to share knowledge together and raise capital, is what happens is they form together, which creates groupthink. And so now the loudest voices, not necessarily the smartest voices, but the loudest voices kind of commandeer this group. And if the group makes a decision and says, well, we think that this is the right decision, it's very difficult for one person in that group to veer out and go against groupthink, because now they're going to look like a pariah. They're going to be contrarian. And if their decision is contrarian and then it's a bad outcome, then they're going to look stupid. And it's not worth it, right? It's not worth the risk. So I think the main point here, which is, I don't think it's net positive for the industry. It's definitely not net positive for the industry, is that as a sponsor like us, if we were to go to an individual person who raises capital and we say, hey, do you want to partner with us in this deal? And if we go to 10 people, maybe we get half of them to say yes, and they want to partner with us. Well, if those 10 people now form into a mastermind group, and then I pitch the entire group on the deal, if the consensus from the group, whether right or wrong, is to invest in the deal, then we'll probably get all 10 to invest with us.